Hello, my name is Andrew Bostian, and I'm the Director of Bloom Shapiro's Business Valuation Services. Thank you for tuning in to our webinar, where we will be discussing the essentials of a business valuation engagement. Let's get started. So getting right into it, we'll be discussing the essentials of a business valuation engagement. What the topics we'll be discussing is, of course, why should you even be getting a valuation? And then once you decide to engage Bloom Shapiro to do a business valuation, what is the process? And as we collect information, what are the methodologies that you use to estimate the value of your business? And what is the deliverable going to be? What's the content of the report? What type of report will you receive? And lastly, I'll conclude the presentation with a description of Bloom Shapiro's business valuation services and all the services that we offer in terms of transaction advisory. My name is Andrew Bostian. I'm the Director of Business Valuation here at Bloom Shapiro. I provide a complete range of business valuation services for owners, attorneys, and financial institutions. My background is a degree from Lafayette College with a major in economics, and as well as a Master of Science in taxation from Northeastern University. Prior to joining Bloom Shapiro in June 2014, I was a senior economist for a consulting firm in Washington, D.C. Now let's discuss why you need to get a business valuation. What are the various reasons that you might need one? Corporate planning. You might be having a potential transaction. Perhaps you received an offer on your business and you want to know if you're leaving money on the table or if it's a good offer. So the first step might be, let's get a business valuation. Succession planning. This is always important for business owners to think about. What am I going to do with my business when it comes time to retire? Who might be the next to step up? Is there someone within the company? Is there a family member? Is there another shareholder? Maybe there's a competitor that might be interested in buying your company. These are things that you should start thinking about before it's time when you wake up one morning and say, I've had it. Plan ahead of time. Bloom Shapiro has this great succession planning process, and it always starts with a business valuation. And maybe part of that process is you're going to have someone buy into your business. Let's put a value on that. So that would be a shareholder buy-in. Or maybe there's a business partner that you want to buy out. That's part of the corporate planning process. You may be raising funds from outside investors. You might want a business valuation for a round of financing. There may be some financial modeling that you might be interested in doing, projecting where you might go, where are your growth areas, where are your strengths and weaknesses. Or you might be putting together a shareholder agreement at the outset of the start of your company. And of course, there's tax compliance. Bloom Shapiro prepares an awful lot of tax returns related to estate tax returns when someone passes away. And if that person, the decedent, owned a business, part of the assets that gets reported on the tax return is the value of the company. Also, in concert with succession planning is estate planning. Oftentimes we have clients who are gifting shares of their business on to the next generation or putting it into a trust. Even though you might be keeping it in the family, so to speak, you still need to get a business valuation done because the value of the company needs to be reported on a gift tax return. We also have many clients who are very charitable with their donations of stock to various nonprofit organizations, oftentimes colleges and universities as well. The business value, like anything that you donate, would also need to be going on a tax return. So we value the company for charitable contributions. A lot of companies are electing to be taxed as an S corporation. And one of the things you do when you elect to be an S corporation is to get a value off the company. We also prepare valuations for equity-based compensation, as well as transfer pricing. So if you're a multinational company transacting with subsidiaries or branches amongst each other, we prepare transfer pricing documentation studies. In financial reporting, if you make an acquisition, you create an opening balance sheet and it's an asset deal, you need to do a purchase price allocation, as well as in subsequent years, goodwill impairment testing. And unfortunately, a lot of times we see businesses that are involved in litigation where there might be dissenting shareholders or lost profits or damages due to the actions of another party, and marital dissolution, where in New England, as well as many states throughout the country, your ownership in a business is seen as a marital asset. So we value companies for marital dissolution purposes as well. We often see tax disputes related to the value of the company, and bankruptcy and restructuring. So once you engage Bloom Shapiro, what is the business valuation process? The first step of the process is we issue an information and document request. And oftentimes, of course, we ask for your financial documentation. We would like to ask for the latest 5 years of financial statements, because that really captures what the business cycle might be. Sometimes 5 years of financial statements might not be available. We can get 3 years of the latest year. How about budgets or forecasts? Do you prepare those in the normal course of business? That would be important for us to see as well. What are your views of the growth of the company? Where do you see the company going and what direction? Customer and supplier information. We would be interested in knowing about where your key customer concentration might be. Do you have, for instance, one customer that makes up more than 50% of your revenues, or one vendor that you purchase from? That would be key to know and understand during the valuation process. Part of the process also is normalizing financial statements. What's the compensation that are paid to the owners? Is it above or below market? How about family members? Are they on the payroll as well? Are they active in the company? And benefits paid to or on or behalf of the owners out of the company. Automobiles, country club dues. These are discretionary expenses that could be considered non-operating expenses. So we would normalize those financial statements. So that's the reason why we ask for those types of that type of information. And for you to grow, what kind of capital expenditures would you need? What kind of equipment do you need to purchase? Any borrowing activities, any bank debt that you might need to take on. So that covers the financial documentation. But once we've had the opportunity to review the financial documentation, we'd like to get some more background on the company's operations. What do you do? What's your day-to-day look like? Can you provide us a history and description of the business? What are your major products and services, and where do you see the business going? Who are the owners? Are they family members? Are you a 100% shareholder? Are there unrelated party owners? Who are the key employees? Marketing directors, CFOs, the people who make the company tick and operate on a day-to-day basis. What would happen to the company if they left? Do you have any non-compete agreements? Who are your key competitors? What's your market share? Kind of an idea of what that might be, both locally and nationally and globally even. And the other information we'd like to know is, how about real estate? The facilities that you operate out of. Is it owned by the company? Do you have it in a separate LLC? Do you lease it from an unrelated party? And legal documents, operating agreements, and buy-sell agreements, employment agreements, something that we would want to take a look at. How about any major changes in the business in the last few years? Intellectual property, do you have any patents that would add value? Trademarks, how well are you positioned in the market? franchise agreements? Are there any existing or pending lawsuits? Once we've collected all of that information, the financial information and the background information, we'll start working into our valuation model. That'll give us a good start. We'd also like to come out and take a visit of your office, your facilities, get to know you as well. So that would be covered in the site visit and the management interview. As we work with the information collected, you might want to know, how is the value determined? Well, there are 3 common approaches to a business valuation. One being the income approach, where oftentimes we would look at your historical cash flows or even projected cash flows if they're prepared in a normal course of business. So if you do prepare projections, we could use what's called the discounted cash flow method. If not, that's fine. We could work with historical cash flow and use what's called the capitalization of historical normalized earnings. And within those historical earnings, we can project out a certain level of growth. Then there's the market approach. You might have gone through a real estate appraisal on your home or your business, and the real estate appraiser probably looked at what other properties sold in your neighborhood. Well, we would do the same thing with the business valuation. We would look at what similar companies have sold for. We would look at the industry and see if there's any good metrics there. If there's a multiple of revenue or earnings. Oftentimes people hear EBITDA thrown around as the key metric, and that is a very common metric that we look at. So if we're able to find transactions of similar companies, we would be able to employ a market approach. Oftentimes we also look at the stock market and guideline public companies and what do they trade at in the stock market. Now those might be much larger companies, so we would have to consider making some kind of adjustment based on size, if this is even an approach that we can use. And then another approach is an asset approach. Really what that does is it looks at your balance sheet and takes everything from book value to fair market value. It's oftentimes not used for a going concern because it doesn't really capture the future earnings of a business. But it is often used for investment companies or holding companies, or even companies that are very asset intensive, that they might own property or they might own a lot of equipment. So it is considered, oftentimes it might be considered as a floor on the value because, like I said, it doesn't measure the potential future earnings of a business. But that is an approach that we look at. And once we look at all those approaches, we try to reconcile back to our opinion of value. So first step is getting a value of the company, but oftentimes we're not just valuing the entire company. We might be measuring the value of a single share of stock or a 1% interest, so to speak. So certain levels of discounts come into play next. And this is very important, particularly if you're doing estate planning. One level of discount is called a discount for lack of control. And that's applied because if you own a minority interest in a company, you don't have the power to make certain management and policy decisions of a business. So a discount for lack of control is applied. Once that's applied, we also apply a discount for lack of marketability. That's always applied for privately owned companies, particularly for minority interests, but could be also applied to majority interests because there's this lack of liquidity in a privately owned company. You can't call a stockbroker and say, I want to sell my shares of my business, like you can with an Apple stock or IBM or something like that. So there's that lack of liquidity element. There may also be transfer restrictions mentioned in an operating agreement. So this is something, a discount for lack of marketability would be applied to the value as well. And then what is included in a valuation report? Oftentimes I get phone calls and say, can you give me a back of the envelope number? Well, the answer to that is really no, because I just explained the process of putting together an estimate of value. It's my opinion of value. I've done all of that work, so you really don't want me to just throw a number out there without some kind of explanation. There are two levels of report that Bloom Shapiro offers, as well as many other appraisers. And one's called the calculation report. And really what that does is it just describes the methodology that we use. We look at all approaches to value, but they have only employed a certain approach to value. And then there's just a limited description of the analysis that's done. Now, I wouldn't recommend a calculation report if you're submitting anything to the IRS or the Department of Labor or going through litigation or even selling to an outside buyer. It would be used, though, in situations where you're just doing some internal business planning or setting up a buy-sell agreement. You just kind of get a baseline level of a calculation of value. So really, a calculation report is just getting to the bare bones of what was the methodology used, how was it employed in a calculation of value. Now, a full valuation report would really put a lot more meat to the bones. What you would see in a full valuation report is an in-depth overview of the company that's being valued. What are the operations? Who's the customer base? Who are the competitors? What are the strengths, weaknesses, opportunities, and threats of the business? That's always part one of the report. Then we do an economic overview. What's the economic outlook? How does that impact the company? What's the disposable income, for instance, or the consumer sentiment if you're a consumer company? What's the producer price index, and how does that play if you're a manufacturing company? So those are the kinds of things that would be discussed in an economic overview. Then we would have an industry overview that would benchmark the industry outlook. What's the industry expected to do, and how does that impact your company? Would you be expected to grow more than the industry, and what might those reasons be? Maybe your market position is stronger. There's certain metrics that we would use to benchmark you against industry peers. So that would happen in a financial statement ratio analysis. We would look at your leverage ratios, your liquidity ratios, your profitability, and really compare that against your industry peers. So this is a helpful exercise. So it really kind of is like a health checkup on your company. Not only are you getting an estimate of value, but you're getting an idea of where your company stacks up against others. So I find that always helpful as well. And then we really get into a detailed description of the valuation methodology. So whereas a calculation report might just look at that last bullet point, a full valuation report would go in depth on all the other areas in the bullet points above. And now Bloom Shapiro's business valuation and transaction advisory services. It's very key when you're getting a business valuation that you're having it done by a certified business appraiser. There are a lot of people who could claim to appraise your business, but if they haven't had the training or the experience, again, you're just getting that back of the envelope number. And that's very dangerous, particularly if you're going through a transaction. You might be leaving money on a table. Or if you're going to go submit something on a gift tax return or a state tax return, and you're leaving yourself up to audit risk. So these are some of the letters after the names that you would be looking for in terms of the alphabet soup for qualified business appraisers. I myself am an accredited senior appraiser through the American Society of Appraisers. Bloom Shapiro also has accredited business valuation, the ABV designation, on staff. And then in concert with our litigation services that we offer, we also have certified fraud examiners and people who are certified in financial forensics. And Bloom Shapiro, of course, being an accounting firm, we have certified public accountants on staff as well. Our staff has performed hundreds of appraisals. We have a dedicated business valuation group. This is what we do. So if you pick up the phone and call us, you're going to get someone who performs valuations day in, day out, and really knows the process inside and out. We've also testified as expert witnesses in state and federal cases, which is important to know that if you're engaging someone for litigation, that we have that expert witness experience. We also have a very strong transaction services group. So valuation is often the first step in the transaction process, But we also have due diligence and quality of earnings assessments. So if you're doing, putting your business up for sale, you might be interested in the sell side due diligence. And that doesn't look at just the financials, but it'll look at your operations, your tax, your IT and cyber, and your human resources, and do an investigative background. We also do, of course, buy-side due diligence, where we employ all those metrics as well, from financial, operational, tax, IT, HR, investigative as well. And we'll perform a quality of earnings assessment, really get down to those normalized earnings and what's the nitty-gritty of the operation. So thank you for listening to this webinar. I tried to cover as much as I could in terms of what the essentials are in the business valuation process. But if you have any questions, please do contact me, Andrew Bostian. My email's listed here, abostian@bloomshapiro.com, and you can find me at any of those numbers listed there.